Hi, welcome to my channel. My name is Gil Rossi, investor and funds manager. Today I want to discuss about investment risks. After watching this video, my objective is that you have a better understanding of what investment risk is and how to approach it. So let's get started. Every time you make an investment decision, you have to think in what is the rewards and risk proposition that you're getting. Normally, if you invest in individual stocks, you have to make sure that you understand specifically what the future entails for that stock or security, and you have to make a fundamental analysis on what are the risks that are involved and the expected returns. When you invest in a portfolio in a broad portfolio of securities, could be in stocks or in bonds or in a mix, you can rely a little bit more on past performance or past variability, and this is what normally is done in the industry, in the financial industry. Like, for example, if you see this is a risk and return from a portfolio performance from a broker, they put risk and return. The green thing is the portfolio. Here is the standard deviation that they are using as a measure of risk. And also, for example, here in this questionnaire about the attitude towards risk, they also use risk and volatility interchangeably. In this graph as well, you have standard deviation and return also as a risk and return graph. So what's a standard deviation? Standard deviation is, as the word says, the deviation from the mean, from the average of a certain set of data. So if you have returns, for example, in this case, how the returns deviate from the mean, from the average, will be the standard deviation of that set of data. So the higher the standard deviation, of course, the more broad that range of possibilities is going to be. If you're investing in a portfolio, you see here that all the different types of different categories of investments, like for example bonds, will fall within a certain range of standard deviation and a certain range of return. And here you have US stocks, which will fall in a higher standard deviation range and a higher return. And this is something that normally has happened in the past, because if you think about it, a bond pays you an interest which is fixed, and so there isn't much upside or downside in the amount that you're going to receive. So the variability of the results are not going to be dramatically big. In terms of the stocks, for example, you get dividends and capital appreciation, and that can vary much higher, especially because dividends can go up or down, or can be cut, while interests are fixed. So if you have a portfolio, this is generally the case. Of course, individually there could be borrower goes bankrupt, or even stocks as well, but in general terms, if you have a broad base of investments, you will be getting this variability and these returns that you see here in this graph on average. In this graph also you see this line, which is the efficient line, which comes from the idea that if you make a portfolio of all these securities that you have here, there is one portfolio which is better than others for a certain standard deviation that you want to get. For example, in this case, the red portfolio is of a lesser quality or less inefficient than this green portfolio, because for the same standard deviation you get a higher return in this green portfolio. So there is a line that for certain standard deviations that you want to achieve or that you want to have, you have the highest return possible. And all this comes from this person, Harry Markowitz, who in 1952 published a paper that was the basis for what then was called the modern portfolio theory, which is a statistical tool to help you create that portfolio. Then he earned the Nobel Prize that you see he has there in his shelf, in his home probably, for that work. That theory also showed that if you have two assets, the standard deviation, when you combine them in the proper way, there will be a point which is the lower possible standard deviation, and this is what you want to achieve. And so the theory caught like fire, of course, in the industry, and has been used since then to build portfolios. And to a certain extent, it's very helpful. But still, if you use it as a shortcut, you will be in trouble, as I want to discuss in a minute. So if we go back to this graph, the standard deviation that they use here is the annual standard deviation. That means the variability of results taken on a yearly basis. This type of graphs is used in the industry to define the type of investor that you are. So for example, here you see investor profile quiz. They put together time horizon and your risk tolerance, and they come with an investor profile and a strategy, which is the same thing that I showed you before in my broker. And here they have different portfolios prepared for different type of investors, depending on the risk that investor is willing to take. And by risk, they mean standard deviation. And so you come from here, from below, and you end up here, and then you say, okay, this is what I want, and everybody's happy. The broker and the advisor charges a fat fee, and you thought that you made your due diligence and your homework because you did the quiz and everything, so you're happy. Everybody's happy, and this is the way that things have been, since 1952. This is what they are missing in those quizzes normally. If I have the Standard & Poor's for the past 28 years, and I plot the average, this is years invested. So if you see here 5, 10, 15, 20, 25, and this is the annual return. So if I stay invested for 1 year on the past 28 years, all the combinations of 1 years that I have for the past 28 years, my return is going to be roughly 10%. And you see that the return doesn't change much the longer term or the shorter term I stayed invested. But what it changes a lot is the variability of the results. So if I stayed invested only for 1 year, or the worst year was a 50% loss, and the best year was a 70% gain. The dotted line is the standard deviation. So you see it is in this axis. You see standard deviation, if you stayed invested for 1 year, is roughly 16-20%, which is similar to what you see in this type of graph. This type of graph is as I said, 1 year graph. So you see that the standard deviation is roughly in the 20% range. But let's go back to this one. The longer you stay invested in the Standard & Poor's, this range comes narrow and narrow and narrower towards the mean. And if you stay invested for 20 years, you see that even the worst 20-year period and the best 20-year period are not dramatically higher or lower than the average. So this is why it's important to invest in the long term. And you see the volatility or the standard deviation has come down to 2%, even lower than if you want to invest in bonds. So, and here you have the marks of standard deviation, which is if this is the average, let's say here the standard deviation is 16%, or roughly, and you have the average, you add the standard deviation, you get this point here, 26%. And if you decrease by 16%, you have roughly 6% negative. These two lines, which are the standard deviation lines, are on average. If this is a normal distribution, the results are in a normal distribution, and this is a bit of statistics. That means that 70% of your results are going to be within these two lines. So this is just for a little bit of statistics to understand better. So if we do the same thing with bonds, and this is the Vanguard Intermediate Term Bond Index, which invests in high quality corporate and also in treasuries, you see that the average doesn't change much if you invest 2, 4, 6, 8 years. But the variability changes. Even the variability is, of course, not that big. It's a 5% variability, not as much as the Standard & Poor's one. But because we discussed this is the case. It's in bonds, the variability is lower if the future is going to be the same as in the past. And the same we have these bands here, the 70% probability bands, which if you see as you invest longer, you get towards the average in the same way that happened with any type of security. And the standard deviation comes much lower as well, even to zero, almost 1%, less than 1%. This is how tight it gets. But there's one thing here that I want to make sure you understand. First of all, this remember is only annual. If you see in this brochure that I showed you, this is what the brokers use to understand whether you are a conservative or an aggressive. So if you are a conservative investor, they say invest in conservatively, and conservatively means 50% bond, 30% very short-term bond, and only 20% in stock market. But they don't care whether you are a long-term investor, short-term investor. They apparently don't think that that's important. But as I showed you, it's very important, because if you have 15 years and your risk tolerance, let's say, is I don't want a variation of more than 4 to 6%, then you will be quite well suited if you invested in 100% Standard & Poor's. If you have 10, 15 years, your variability is going to be, even less than what you're expecting. So that's one thing. Make sure that you understand that this normally is an annual graph. But the long-term graph is more important, because that's reality. The second thing that is important to understand in this type of graphs is that return is based on the past returns, and standard deviation is based on this past variability. If you invest in portfolios, probably the future will be quite similar, because the fact that you're investing in a portfolio, bonds will do well, some of them will not do that well, but on average they will do similarly than what they have done in the past. The other important thing to consider is that these are the benefits of diversification and the benefits of thinking long-term and investing long-term, as I showed you here. But there is no shortcut to making your own assessment of the risk. And risk really is not standard deviation. Risk is the probability of permanent loss. And of course, there are shortcuts, as I said, especially in portfolios, they can work a bit better. But what if this average return is a poor return or a return where you're losing money? Of course, the long term is not going to help. In fact, the long term is going to make more certain that you are losing money, that you're going to lose money. So this is something that you have to analyze. I mean, I'm sure that the future is not going to resemble the past at this specific point, especially if you invest in bonds. Let's pause here, and instead of showing you a real world example, that was what I was going to do now, to keep the video not that long, which was my intention to keep it in the 15-minute range, I am going to show you this video and this example in the next video. So please subscribe so that you get informed when I upload this new video, and hope that you like this video. If you do, please give it a like. Thanks very much for watching, and see you in the next video.